Assalamualaikum and hi, my name is Nur Syafiqah binti Muhammad Hanafiah. Today, I would like to explain to you about the time value of money or TVM in Chapter 6 while working capital management in Chapter 7. The term time value of money refers to the fact that a sum of money is worth more now than it will be in the future. It is due to the fact that money can only expand through investment. An investment that is postponed is a missed opportunity. The time value of money formula takes into account the amount of money, its future value, the amount it can earn, and the time frame. The number of compounding periods in a savings account is also a significant factor. Because a sum of money, once invested, grows over time, investors prefer to receive money today rather than the same amount of money in the future. Money placed in a saving account, for example, earns interest. Interest is added to the principal over the time, earning more interest. Compound interest has that kind of the power. The time value of money concept can assist in making investing decisions. We go through one by one. Firstly, future value or FV, the worth of a current asset at a future date based on an estimated rate of growth is called future value. Investors and financial planners respect future value because it allows them to anticipate how much an investment made now will be worth in the future. Investors can make informed investment decisions based on their anticipated demands by knowing the future worth. The future value calculation allows investors to make reasonable assumptions about an investment earnings. Because of market volatility, determining the future value of a market investment can be difficult. First example is single cash flow in finding future value. The question is 1,500 deposited to bank saving account that gets 6% interest compounded annually. How much the value worth at the end of year 3? Using the future value formula that have been bold, then identify the information such as 1,500 is present value, then replace it in the formula, then you will get the answer is 1,259.43 cents. Next is to calculate future value in multiple cash flow. The question is you deposited money in the saving account given 5% interest per annum. You will deposit 100 at the end of year 1 and 200 at the end of year 2 and 300 at the end of year 3. How much the money at the end of year 3? Using the formula, then identify the information and replace it in the formula. You will get the answer is RM 577.68. Divided into two, which are ordinary annuity and annuity due. The ordinary question is you expect to receive 3,000 at the end of next 3 years. What is the cumulative value if the discounted rate is 7%? Using the formula given, replace all the information in the formula using the TVM table to get the FVIFA. Such look at the 7% at the interest column in 3 years at the period column. Then you will get 3.2149 and multiply with annuity amount, which is 3,000. The answer is 9,644 and 70 cents. Also, same with the annuity due. You need to identify the information, then replace it in formula using the TVM table to find FVIFA and find 7% in interest column and 3 years in period column. You will get 3.2149 and multiply with 3,100. The answer is 10,663 and 82 cents. Secondly, present value or PV. The concept of present value states that an amount of money today is worth more than an equal amount in the future. To put it another way, money received in the future is worth less than money obtained today. Also, the powerful tool in financing decision, especially in capital budgeting. It is reciprocal from FV. Discounting is a process to determine the present value of cash flow that will receive in some future date. First example is single cash flow in finding present value. The question states that you need 25,000 ringgit to build a business in 5 years. Given discounted rate is 5%. What is amount for today? We can use the present value formula that future value FV divided 1 plus K and square of N. K here means interest and N here means time of frame. So, we put the information in the formula 25,000 divided 1 plus 0.05, the square of 5, and the answer is 19,588. Next is to calculate the multiple cash flow. The question is you are expected to receive RM 150 today, 300 in 1 year and 550 at the end of year 3. Given 6% interest rate and what is the present value? Can use the formula that have been bold, then identify information and you will get 810 ringgit and 85 cents. Also for annuity, it will be divided by 2, which are ordinary annuity and annuity due. The ordinary annuity question is you expect to receive 300 at the end of year for 3 years. What is the present value of this cash flow if the discounted rate is 7%? Using the formula and identify the information, you will get the answer RM 787.29. The answer will be found by using TVM table according to interest and year. You get 2.6243, then you multiply with 300. Also same with annuity due, the present value can be found by formula then using TVM table. We continue to topic working capital management. Working capital management involves day-to-day decision on administration of the firm's current asset and the financing needed to support current asset, or in other words, investment in current asset. Working capital management help maintain the smooth operation of the net operating cycle, also known as the cash conversion cycle. The minimum amount of time required to convert net current asset and liabilities into cash. Working capital management can improve a company's cash flow management and earnings quality through the efficient use of its resources. Management of working capital includes inventory management as well as management of accounts receivable and account payable. Working capital management also involves the timing of account payable. Example, paying supplier. A company can conserve cash by choosing the stretch to payment of suppliers and to make the most of available credit, or may spend cash by purchasing using cash. These choices also affect working capital management. There are 3 basic working capital policy, which are relaxed policy, restricted policy and moderate policy. Relaxed policy is the low risk policy. In this policy, the evaluation of current asset is made after carefully examining uncertain occurrences such as seasonal variation, a sudden shift in the level of activities or sales, and so on. Companies with relaxed working capital policies assume the advantage of almost no risk or low risk. Restricted policy is totally opposite with the relaxed policy because in a restricted policy, current asset estimation for obtaining targeted revenue is done very aggressively without any contingencies or provision. Following the decision, these policies are enforced throughout the organization with no exception. Because of the reduced level of current asset, adopting this approach would result in a lower working capital demand. Moderated policy is the moderate approach strike a balance between the 2 policies of restriction and relaxation. It assumes both policies' properties. To achieve a balanced moderate policy, assume that the risk is lower than restricted but higher than conservative. It is also in the middle of the 2 in terms of profitability. The most significant advantage of this approach is that it provides considerable certainty of smooth working capital cycle with moderate profitability. There are also 3 approaches to working capital management, which are maturity matching, hedging approach, aggressive approach, and conservative approach. Maturity matching approach matches the maturity of the asset with the maturity of the financing. For example, firm uses temporary financing to finance temporary current asset and permanent financing to finance permanent assets. Since the approach matches the financing duration and the asset requirements, there is no need for emergency fund and idle funds or non-existent. This approach results in moderate risk with moderate returns. The last is conservative approach. This approach offers lowest level of risk compared to other working capital approaches. The firm uses long-term financing for the majority of its asset. The firm support fixed permanent current and average temporary current asset with long-term financing. Therefore, the firm assured of the availability of fund even during period of tight money supply. Most of the time, the firm will have excess liquidity and this reduces the need for temporary financing. Hence, it results in lower risk of technical insolvency. This strategy possesses low risk and low return. That's all. Thank you.